Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, March 3rd, 2023. ISM services came in very strong, particularly with new orders moving higher. Concern clearly on the manufacturing side of the equation, no concern here. We're seeing good order flow. We're seeing firms reacting to better activity as the spring season. It seems that concern about too much inventory build has actually moved away. In addition, we see healthy numbers in the side of the equation on employment. That again, stable is good here. We've seen concerns about weak activity. We had a huge drop down in December, better January, and now an extension into February. Wondering whether that would take some steam off of the employment number. It did not. So that's good news there. Firms are continuing to be worried about having skills and the need to backfill, which means they have vacancies, and these vacancies are persisting, and probably would have used the vacancy as a way to cut costs, but can't because orders are coming in at a good rate. Particularly noteworthy is prices paid. This is still a work in progress for the marketplace and clearly for the Fed too. What do I mean by that? We had numerous prints that were at the 70 level for prices paid. That's a huge expansion level. Then we've seen it moving down to the 60s, and we've had consistent prints in the 60s. Yes, we have not seen a negative print, and we did not see the December overall number that fell into contraction push the prices paid lower. So there really wasn't any connection there. Now that the overall number is higher, what you're seeing is continuing pressures out there. But there's some sense that the buying and selling is kind of equalizing better. So the distortions in the market are actually easing. And that's commentary we're hearing from the firms. I would suggest that's actually a healthy sign as we look forward, because it tells you that distortions, and it's really easy, particularly on the service side, to have a distortion because you don't have the ability to use productivity. If someone cuts hair, it's hard to be more productive at cutting hair. So you have to increase your prices to pass along expenses, rent, healthcare, and all those things that someone is facing and needs to be compensated for. So those elements continue to be improving because the lack of productivity pickup can distort, can even make no price available. So yes, it is still a problem. It's something that will persist. And clearly, the Fed cannot claim victory on inflation yet, particularly in the service side of the economy. However, there does seem to be a little bit of improvement there. For the recession, as people say, it seems like it's going to be a longer goodbye for this economic cycle, which means that the potential for a downturn happening this year is starting to fade. It may be early next year. At some point, even a technical recession, meaning 2 quarters of negative GDP growth, particularly from the lofty level that we have been at since the pandemic, is not unexpected and not, I would say, very important. It means that there are some volatility in the business cycle, and that does play out. But having the severe recession where we have too much inventory, we have large layoffs and job cuts to try to straighten out this too much material or too much employment element doesn't really seem to be in the cards. I know we're in a weird part of the month where we're expecting the jobs number should see it around 230,000 200, excuse me, or 300,000, which tells you that it's going to be pretty good. And so healthy service number, manufacturing continues to be not so good, but with prospects for a good jobs number and continuing to be this battle about inflation, we could actually start hearing rumblings of a 50 basis points hike at the end of the month. Not going to go there yet. We think that it's not expected, and the Fed will definitely clearly tell the marketplace, particularly since they downshifted to a 25 to go back to 50. But it's worth keeping our eyes on because the numbers are coming in better. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.